Technology stocks have experienced a sell-off over the past month, with the Nasdaq index declining by over 10% since its peak in mid-February. A major contributor to this drop has been rising inflation and the possibility of an interest rate hike in the near future. Rising inflation is good for companies in the banking, energy, and commodities sectors. In contrast, it is not so great for tech companies, particularly smaller companies that rely heavily on venture capital and private finance. This has caused investors to switch their attention to value stocks, which are set to recover post-pandemic. Those who regularly watch this channel will know that we have been looking at value stocks for months, and in some cases have already doubled our investment. With the recent drop, there is now an opportunity to purchase growth stocks at a discount, and in this video, we will look at one of the companies that proved to be very popular during the growth stock boom in 2020, with investors such as Cathie Wood's ARK Invest. This company is Fastly. Between March and October 2020, Fastly's share price increased by an eye-watering 800%. It has since declined by 40% since its October peak. We will complete a review of Fastly to determine whether the company is currently trading at a decent price, or is it completely overvalued even with its recent price correction. So, join us as we look at Fastly on today's Investment Store. Welcome to the Investment Store, the personal finance channel that reviews a diverse range of investment asset classes, from stocks and ETFs through to real estate and cryptocurrencies. If you enjoyed this video, please click the like button and leave a comment. And if you like our content, then please subscribe to the channel to become part of the Investment Store community and hit the notification bell to ensure that you never miss an episode. With that said, let's commence with today's video. Fastly is a cloud computing services provider founded in 2011. The company went public in 2019. Fastly offers an edge cloud platform to help developers extend their core cloud infrastructure to the edge of a network. This essentially means that their clients can bring more of their data closer to them, giving them more control and assurance of data security. Edge cloud services are expected to disrupt traditional central cloud services, as central cloud revenue is based on the monetization of units of computing power, storage, and bandwidth. Edge cloud costs will be lower since less traffic is required to transit back and forth from the central cloud to the end user. It will also consume less energy than traditional content delivery networks or CDN. Fastly's typical customer is an enterprise or a large business which handles large volumes of data traffic. The business has received plenty of media attention and are considered by many to be a company to watch in the future. We will now complete a review of Fastly using our Investment Store 4-step approach to analysing stocks. This involves looking at the economic moat of the business, the fundamentals of the business, looking at financial statements and investment ratios, completing a comparison with the company against its peers, and finally looking at the intrinsic value of the stock. Once we have completed our 4 steps, we will aggregate these scores to generate the Investment Store score. Now, with that said, let's commence with today's analysis. Looking first at the intangible aspect of the Fastly business. Fastly estimates that it has a total addressable market of $35 billion, which is equally weighted between its edge and security services and its CDN and streaming services. Fastly generates over 80% of its revenue from enterprise customers, and its clients include high-profile names such as Microsoft, Google, Spotify, and Twitter, to name a few. This is good for its brand, so we score Fastly an 8 out of 10 for intangible aspect. Looking next at switching costs. Edge cloud computing allows organizations to build more efficient computing infrastructure. This technology can be disruptive as it allows users to have more control of their data. There are, however, technological alternatives to edge cloud computing, such as blockchain-driven enterprise computing, and this could pose a threat to Fastly's business model over the long term. Therefore, we give them a 5 out of 10 for switching costs. Next, looking at the cost effect. Fastly provides access to its platform through a freemium model. which gives customers the option to test their services for free before purchasing a package. It is anticipated that as developers and organizations become more familiar with the platform, customers will opt for paid subscription and enterprise services. Fastly's open source operations also allow customers to get quicker access to the platform, which leads to higher sales. This is a strategy that's adopted by most software as a service or SaaS companies. Fastly's annual sales have been increasing steadily over the past 3 years. However, it is yet to make a profit, so it's unclear how effective their pricing strategy is. For this reason, we score Fastly a 5 out of 10 for cost effect. Looking next at network effect, developers play a key part in Fastly's business model. As Fastly's Edge Cloud platform gives developers more control of features such as security, reusable modules, and agile development, it's believed that this will play to Fastly's advantage as they can build a community of developers who will continue to use the platform. Fastly's results show that they have successfully managed to retain customers with a 99% annual revenue retention rate. Now, this is one of the most important numbers to pay attention to for any SaaS business, and Fastly is no exception. With the growth of 5G networks and Internet of Things, Fastly are well placed for their services to grow over the next few years. So we score them a 7 out of 10 for network effect. Finally, in terms of scalability, Fastly has a SaaS business model for individual customers, but it relies heavily on sales teams to acquire target enterprise clients. For each enterprise client, Fastly will deliver a custom solution that allows them to satisfy a specific need. Fastly currently has an estimated 3% market share of the edge cloud computing market, which is growing, and they have experienced a 45% compounded annual growth rate. At this rate, Fastly could potentially become profitable by 2024. We score Fastly an 8 out of 10 for scalability for this reason. This gives Fastly an overall economic moat score of 6 out of 10. Let's now complete a fundamental analysis on Fastly. As we can expect from a tech company that has recently gone public, Fastly is yet to record its first profit as a publicly owned business. However, when investing in growth stocks, we need to be open-minded and focus on growth patterns. Therefore, the following numbers are useful when analyzing growth stocks. First, we want to see that Fastly's sales are growing steadily. Looking at their numbers, we can see that revenue has been growing year on year by an average of 35%. We score Fastly an 8 out of 10 for revenue. Next, looking at Fastly's operating margin. Although these numbers are negative as the company is losing money, we would like to see these numbers get smaller year on year. Now, unfortunately, this is not the case as far as Fastly are concerned, as we can see that their operating costs are growing year on year, most likely to support their sales and admin in order to reach more enterprise customers. We're not great fans of this type of business model where growth depends heavily on sales teams. So for this reason, we score Fastly a 1 out of 10 for operating margin. Next, we want to see that the business has sufficient working capital to manage its operations, and the current ratio provides a good indicator of this. Fastly's current ratio is over 1, although it has been reducing over the past 4 years, so we score them a 6 out of 10 here. Next, looking at Fastly's return on asset and return on invested capital. As expected, both numbers are negative. However, they are both reducing each year, which is a positive sign. So because of this, we score ROA and ROIC a 4 out of 10. Next, let's look at the debt to equity, as we want assurance that the business is not heavily debt laden. We can see that Fastly's debt to equity has gone from a negative value, meaning it had more debt than equity, to a positive and low value, which is ideal. This implies that the management are controlling their debts, which is positive, so we score them an 8 out of 10 here. We'll now look at the price to sales ratio, as this ratio allows us to quickly assess whether a growth company is trading at a reasonable price. We quickly notice that Fastly is currently trading at 26 times its annual revenue, which is very high. As a comparison, Amazon, which is also highly priced, has a price to sales ratio of only 4.11. So we score Fastly a 1 out of 10 as the stock is currently expensive. Next, let's look at the PEG ratio. As earnings are negative, PEG is also negative. We can accept this, but what we want to see is this number getting closer to 0, as this means that the growth rate is increasing. In Fastly's case, the number is going further into the negative, which is not a good sign. So we score Fastly a 1 out of 10 here. And finally, let's look at Fastly's free cash flow yield. Again, as we'd expect, the free cash flow yield is currently negative. And again, we would like to see this value get closer to 0 and go into the positive. Now, the negative numbers are trending in the right direction, so we score Fastly a 5 out of 10 for free cash flow yield. So, for our fundamental analysis, we've given Fastly a score of 4 out of 10. Next, we'll compare Fastly against some of the companies that are also in the edge cloud computing market. Cloudflare, like Fastly, are a startup that recently floated on the New York Stock Exchange. We will also compare Fastly against some more established companies like Verizon and Akamai, who are two of the leading companies in the edge cloud computing space. And we will also compare these companies with the SPDR XLK ETF, which is one of the leading technology ETFs on the market. And we always do this to assess whether our money is better placed in a stock or in an ETF. Looking first at the PE ratio, Fastly and Cloudflare are both negative in this area, but Cloudflare's numbers are slightly better. So we score Fastly a 3 out of 10 for PE ratio. Next, looking at the operating margin, Fastly has the weakest operating margin of the group, so we score them a 1 out of 10 here. Fastly also has the lowest gross margin out of the group, but because this is more in line with its peers, we scored them a 4 out of 10 for gross margin. Onto price to sales, we immediately noticed a stark difference between the startups and their established counterparts. Both startups are expensive, so we score Fastly a 1 out of 10 for price to sales. Looking next at return on asset, Fastly has the lowest return on asset on the list, so we score them a 1 out of 10 for this. Next, we'll look at the PEG ratio. Fastly are edging towards 0, which is positive, and are in a better position than Cloudflare from an earnings perspective, so we score them 5 out of 10 for PEG in a comparison setting. For debt to equity, Fastly has the lowest of the group, so we scored them a 10 out of 10 here. Fastly's current ratio is the second highest of the group, so we've scored them a 6 out of 10. And then looking next at the cash ratio, we notice that both startups have high cash ratios. Presumably, this is investors' cash rather than cash generated from earnings. So for this reason, we'll score them a moderate 5 out of 10. And finally, looking at the 6-month price difference of the stock, Fastly is currently down by over 40%. This shows that there may be upside potential depending on what happens with interest rates and inflation. So we've scored Fastly a 7 out of 10 for price difference. Taking all of this into consideration, we have given Fastly a score of 5 out of 10 when compared to other cloud computing platform providers. The final step in our analysis is to determine the intrinsic value of the stock. Now, to determine the intrinsic value of a growth stock that is yet to make a profit, we find that the compounded annual growth rate calculation is a reliable method to use. We can do a separate video about this if members of the community request it. Now, if we estimate a 30% compounded annual growth rate of Fastly's annual revenue and estimate that expenses continue to increase at their current rate, we obtain an estimated earnings per share of 2 by the end of 2024. This equates to a 39% annual growth rate on their existing earnings per share. Then using an estimated future PE ratio of 50, we obtain a projected share price of $100 per share by the end of 2024. This equates to a current intrinsic value of $49 per share. Now for comparison, Verizon and Akamai each have an EPS of 4.3 and 3.4 accordingly. If we used a future EPS of 4.3 in our calculation for Fastly, we obtain a current intrinsic value of $160 per share. Now, in order for Fastly to achieve this, they would need an annual revenue growth rate of 45% and earnings growth rate of 62% per annum. Using a slightly more conservative revenue growth rate of 35%, we calculate an intrinsic value of $97 per share. Based on Fastly's numbers over the past 3 years, we're not confident that Fastly will achieve an EPS greater than 2 by the end of 2024. Achieving this would require them to significantly increase their market share with modest increases to their advertising costs. Therefore, we believe that an intrinsic value of $49 is probably the most accurate of these three. And with this in mind, we give Fastly an intrinsic value score of 2 out of 10. So to recap, Fastly has recorded the following scores in each area of our analysis. This gives them an ISS of 4 out of 10. Fastly have an exciting business with potential to disrupt the cloud computing market with their edge cloud platform. Their low score reflects the fact that the company still needs to prove itself in order to justify its current market valuation. Like so many other tech stocks, investors have bought Fastly on speculation without placing much focus on its fundamentals. Now, having said all of that, the company could still see its share price return to its October 2020 highs if interest rates remain low. If we were planning to purchase this stock, we would like to see it fall below our intrinsic value of $49 per share, and we'd probably apply a 20% margin of safety for added measure. We would also pay close attention to its earnings per share when it reports its quarterly results to ensure that the EPS targets remain on track. Thanks for watching. If you enjoyed this video, please leave a like and let us know what you think of our findings. If you'd like to learn more about how we analyze assets, then please subscribe to the channel and visit our website. We look forward to seeing you on the next video.